Welcome to the deep dive. Looks like someone's been brushing up on their financial wisdom.
Yeah, quite the stack of reading notes you sent us.
You've got Warren Buffett, Charlie Munger, Sir John Templeton, Howard Marks. The list goes on.
All titans of investing.
Clearly, you're trying to decode the secrets to their success.
And what's fascinating is how different those paths to success have been. Each investor, they have their own style, a unique way of looking at the world, making decisions. It's not just about picking the right stocks, it's having a framework, a philosophy that guides your actions.
Okay, let's unpack this. You've got notes on folks who built fortunes during times of war, economic crashes.
You name it.
What can we learn from their investment styles? Let's start with, the dynamic duo,
Okay.
Warren Buffett and Charlie Munger. What makes their approach so distinctive?
Well, I mean, they're all about finding those wonderful companies.
Yeah.
Businesses with strong fundamentals, a competitive advantage, a management team they believe in. But it's not just about finding great businesses. It's about buying them at the right price.
Mm-hmm.
They're value investors at heart, always looking for a bargain.
Here's where it gets really interesting.
Okay.
They talk about this idea of an inner scorecard.
Yeah.
What exactly does that mean?
Well, it's about judging yourself by your own internal standards,
Right.
not by external metrics, like how much money you've made
Yep.
or what other people think of you.
Uh-huh.
It's about doing the right thing, even when no one is watching.
Okay,
They believe that true success, it's about more than just financial gain.
so it's not just about the numbers. It's
Yeah.
about building a life
That,
of integrity and purpose.
Yeah.
And they walk the walk, too, with their incredible philanthropy. Now, you mentioned they're always looking for a bargain. Didn't Buffett himself initially consider his investment in Berkshire Hathaway a mistake?
he did. He bought it as a textile company. And that part of the business was actually struggling. But he saw the underlying value and eventually transformed Berkshire Hathaway into this massive holding company.
Yeah.
It's a perfect example of their patience
Yeah.
and their ability to see value where others might not.
So they're long-term thinkers,
Yeah.
not afraid to go against the crowd. And I love that story about Charlie Munger's Too Hard box. Literally a box on his desk where he puts ideas that are too complex
Yeah.
or outside his circle of competence.
Right. It's brilliant. It's a reminder to focus on what you know, what you're good at. Don't get distracted by shiny objects or investments that are beyond your understanding.
It's about knowing your limits
Mm-hmm.
and sticking to your strengths. Now, speaking of people who have learned from Buffett and Munger, you've got notes on Mohnish Pabrai. He's made a career out of cloning their investment style.
Pabrai. Oh, he's an interesting case. He's openly admitted to modeling his investment approach after Buffett and Munger. He's even referred to his life as a 30-year game to turn $1 million into $1 billion by following their playbook.
Wow. Yeah. And he's taken their philanthropic approach to heart, too, with his work with Dakshana, an organization that helps underprivileged students in India.
He even said that he modeled his experience setting up Dakshana on Buffett's relationship with his longtime business partner. He is a true believer in the power of learning from the best.
Okay, let's move on to another investing legend who had a very distinct style, Sir John Templeton. This guy was a master of contrarian investing,
Oh, yeah.
buying when everyone else was selling, selling when everyone else was buying.
Templeton was famous for his investments during World War II.
Right.
While most people were panicking, he saw an opportunity in undervalued stocks. He believed that the point of maximum pessimism is often the best time to buy.
Talk about nerves of steel.
Right.
But it wasn't just about being contrarian for the sake of it, was it?
Right.
He had a deep understanding of history, economics, and human psychology.
He knew that markets, they're driven by fear and greed.
Yeah.
And he was able to capitalize on those emotions by staying disciplined and sticking to his principles. He even made a fortune shorting dot-com stocks during the bubble,
Really?
a move that many thought was crazy at the time.
It's about having a long-term perspective
Hey,
and not getting swept up in the short-term frenzy.
he had a saying, the crowd is always wrong.
I love that.
And his mentor was the one who told him that.
Clearly, it served him pretty well. He wasn't just about making money, though, was he?
No, he was a deeply spiritual man who believes in giving back. He was a major philanthropist and lived a very disciplined life, focusing on self-reliance and service to others.
A truly remarkable figure. Now let's shift gears and talk about someone who has a knack for making complex investment concepts understandable. Howard Marks. He's known for his insightful memos on market cycles and risk assessment.
What's fascinating about Howard Marks is his emphasis on understanding the cyclical nature of markets. He believes that everything that's important in investing is counterintuitive,
Okay.
meaning that the best opportunities often arise when things seem the bleakest.
And this guy knows a thing or two about distressed assets. He built his fortune by investing in companies and securities that others wouldn't touch.
He started his career just as new forms of credit were booming.
Oh, wow.
He recognized the opportunity in these so-called risky assets, and his expertise in high-yield bonds and convertible securities eventually paid off big time.
And he doubled down on that approach. During the 2008 financial crisis,
Oh, yeah.
buying up distressed assets, when everyone else was running for the hills.
He understood that true value often lies where others are too afraid to look. He had the courage to act when others were paralyzed by fear.
So it seems like his investment style is all about recognizing those moments of extreme pessimism and having the conviction to act decisively. It's about understanding that the market, it's a pendulum that swings back and forth. And those who can anticipate those swings can reap significant rewards.
It's about being a contrarian when it matters most. Speaking of which, let's talk about a pair of investors who also made a career out of zigging when others zagged. Jean-Marie Aveyard and Matthew McLennan. These guys are known for their incredibly disciplined value investing approach, aren't they? Yeah. I'm particularly curious about Aveyard's experience. During the dot-com bubble, it must take an incredible courage to resist the tech frenzy when everyone else was piling in. Oh, it did. For several years, he underperformed significantly because he refused to buy those overvalued tech stocks. Imagine the pressure he must have faced.
Yeah.
People were probably questioning his sanity. It's easy to get caught up in the hype, especially when you see your peers raking in the profits. What kept him grounded during that time? He stuck to his principles and focused on the long term. He knew that the bubble would eventually burst, and he was patient enough to wait it out. And he was right. When the market crashed, his portfolio, it held up remarkably well because he had avoided all those high-flying tech stocks that came crashing back down to earth.
That's a powerful lesson in resilience
Yeah.
and sticking to your guns. And this commitment to long-term thinking was shared by his successor, McLennan, right?
Absolutely, McLennan. He has this great analogy about the investment landscape. He compares it to living on a fault line in San Francisco.
Okay.
You know there's a risk of an earthquake, but you can't let that fear paralyze you.
That's such a great way to put it. You have to acknowledge the risks, but you can't let them control your decisions.
So how did this philosophy translate into their portfolio construction? Did they shy away from specific assets or sectors?
They were both very cautious about debt and leverage. They understood that excessive borrowing can make you extremely vulnerable, especially during unexpected downturns.
So they were all about protecting capital and building a margin of safety into their investments. Sounds like a recipe for long-term success, especially during turbulent times. Exactly. They were playing the long game, and their patience and discipline eventually paid off.
Okay, let's talk about another duo who seemed to embody that calm, steady approach. Nick Sleep and Qais Zakaria. They were early investors in Amazon, weren't they?
They were.
It seems like a no-brainer now, but back then it was a bold move.
They poured 20% of their fund's assets into Amazon back in 2005. They saw the company's long-term potential, even when others were skeptical.
And this was at a time when even George Soros, one of the most successful investors of all time, was shorting Amazon. What gave Sleep and Zakaria the conviction to make such a big bet?
They did their homework. They understood Amazon's business model and saw the parallels between Amazon and other retail giants like Costco and Walmart. They recognized that Bezos was building a virtuous cycle.
Hold on. I think we need to unpack that term a bit. What exactly is a virtuous cycle in business?
It's a positive feedback loop where success in one area reinforces success in other areas. In Amazon's case, their relentless focus on customer satisfaction led to increased sales, which allowed them to invest in even better technology and logistics, which further improved the customer experience, and so on.
So it's about creating a system that constantly reinforces itself, leading to sustainable growth.
Exactly. Sleep and Zakaria saw that potential in Amazon, and their early bet paid off handsomely. But they weren't just about tech giants. They had this incredible knack for finding value in the most unconventional places.
Didn't they invest in Zimbabwean stocks during a period of hyperinflation? That sounds incredibly risky.
It was, but they saw an opportunity. Where others saw only chaos, they understood that extreme pessimism can create incredible bargains for those who have the courage to act.
So they were contrarians at heart, always willing to look where others wouldn't dare. But it wasn't just about making money for them. They structured their fund in a way that prioritized their clients' returns above their own fees.
They even insisted on a very equitable ownership structure, demonstrating their commitment to fairness and partnership. They clearly cared about building a sustainable and ethical business as much as generating returns.
That's impressive. Okay, let's switch gears and talk about a guy who seems to have a knack for spotting innovative companies. Will Danoff. He's been running Fidelity's Contrafund for over 3 decades, with incredible success.
Danoff's investment style is all about finding companies that are disrupting industries and shaping the future. He focuses on long-term growth potential, ignoring the short-term noise that the market often generates.
I read that one of his strengths is his ability to connect with company founders and CEOs. He's not just looking at numbers on a spreadsheet. He's trying to understand the people behind the business, their vision, their passion.
That's right. He's known for his insightful conversations with business leaders like Howard Schultz of Starbucks and Elon Musk of Tesla. He recognizes that great companies are built by great people.
So it's not just about understanding the products or services. It's about understanding the visionaries behind them.
Exactly. He believes in the power of simplicity, finding great companies, led by visionary leaders, and then having the conviction to hold on for the long ride. That's his recipe for success.
Speaking of long-term thinking and discipline, let's discuss someone who embodies those qualities. Tom Gaynor. He takes a very methodical and balanced approach to building a resilient portfolio.
Tom Gaynor, co-CEO of Markel Corporation, focuses on investing in companies with strong reinvestment dynamics.
Okay, I have to admit, that's a new term for me. What does reinvestment dynamics mean in this context?
It refers to companies that can reinvest their earnings effectively, generating sustainable growth over the long term. Think of companies that consistently find ways to improve their operations, expand into new markets, or develop new products and services.
So it's not just about generating profits, it's about how effectively those profits can be used to fuel future growth.
Exactly. Gaynor uses a simple 4-question test to evaluate potential investments. He asks, can I understand the business? Is it run by honest and able people? Does it have a high return on capital? And most importantly, is the reinvestment dynamic favorable?
That's a really clear and practical framework. It seems like he's not just looking for a quick return. He's looking for companies that are built to last.
And this disciplined approach isn't just limited to his investing. He applies it to his personal life as well. He's all about establishing good habits that compound over time, whether it's in his diet, exercise routine, or decision-making process.
So it's about consistency, discipline, and making those small choices that can have a big impact over time.
Exactly. He's a true believer in the power of compounding, both in investing and in life.
Okay, now we have to talk about Joel Greenblatt, the guy who seems to have cracked the code when it comes to finding good companies at bargain prices. What's his secret?
Greenblatt. He's a value investor with a very unique approach. He focuses on 2 key metrics: return on capital and earnings yield. Return on capital tells you how efficiently a company is using its resources to generate profits. And earnings yield, it measures the return you get on your investment relative to the stock price.
So it's like finding a double discount. A high return on capital and a high earnings yield suggest that you're getting a great business at a great price.
Exactly. He lays out his strategy in his book, The Little Book That Beats the Market. And he even provides a formula that investors can use to screen for stocks that meet his criteria.
I love that he's made this approach accessible to everyday investors. You don't need a PhD in finance to understand and apply his principles.
He believes that investing doesn't have to be complicated. He focuses on 1-foot hurdles rather than 10-foot hurdles, keeping things simple and straightforward.
Now, we've talked a lot about different investment strategies, but there's one concept that seems to run through all of them: the importance of avoiding stupidity. This is something Charlie Munger has emphasized throughout his career.
He believes that it's more important to avoid making big mistakes than it is to try to be brilliant all the time. He says, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent.
So it's about playing defense, recognizing your limitations, and making sure you don't do anything that could blow up your portfolio.
Exactly. It's about minimizing downside risk and letting the power of compounding work in your favor over the long term.
And he has a really interesting way of approaching this. He talks about the idea of invert, always invert. What does that mean?
It means thinking about problems backward. Instead of trying to figure out how to achieve a certain outcome, he suggests that we first ask ourselves, what could I do to really screw this up? By understanding what could go wrong, we can take steps to avoid those pitfalls.
That's so counterintuitive,
Yeah.
but it makes perfect sense. It forces you to think about all the potential blind spots that you might otherwise overlook.
It's about acknowledging our own biases and tendencies towards irrationality. He believes that recognizing and understanding those biases is the first step towards avoiding them.
So if you want to avoid making stupid mistakes, start by figuring out how you might make them. That's brilliant advice.
It's a powerful mental model that can be applied to investing and decision-making in all areas of life.
Now, before we wrap up this deep dive, we need to talk about one more investor whose story is both inspiring and incredibly insightful. Arnold van den Berg. This guy faced incredible adversity in his early life, surviving the Holocaust as a child. Yet he went on to become one of the most successful investors of his generation.
Van den Berg's story, it's a testament to the human spirit's ability to overcome even the most challenging circumstances. And his investment style is just as fascinating as his personal journey. He was a deep believer in the power of the subconscious mind.
Okay, now this is where it gets really interesting. Tell me more about this connection between his investment approach and the subconscious mind.
He believed that our thoughts and beliefs have a profound impact on our actions and ultimately our results. He used techniques like hypnosis and positive affirmations to overcome his doubts and fears and to program himself for success.
So it was essentially training his mind for success in the same way that an athlete trains their body for competition.
Exactly. He took those principles of athletic training, setting goals, visualization, positive self-talk, and applied them to his investing career. And it wasn't just about making money for him. He was deeply committed to ethical business practices and believed in finding a purpose beyond just financial gain.
He even refused to sell his company when offered millions because he didn't trust the potential buyers to uphold his ethical standards. That speaks volumes about his character.
He was a remarkable individual
Yeah.
who believed in living a life of integrity, purpose, and inner peace. His story is an inspiration to us all.
Okay, so we've covered a lot of ground today, exploring the investment styles and philosophies of some of the greatest investors of our time. What are the key takeaways that our listener can apply to their own investment journey? It's amazing, right? Each investor we've discussed, they've found their own unique path to success. You've got value investors like Buffett, Munger, Greenblatt, contrarians like Templeton, Marx, growth-focused investors like Danoff. And then you have folks like Sleep and Zakaria, who just, they defy categorization.
And that's what makes this so fascinating. There's no one-size-fits-all approach to investing. It's about finding a style that aligns with your personality, your risk tolerance, and your long-term goals.
It's about understanding yourself as much as it is about understanding the markets. What are some of the common threads that run through all these different investment styles?
One thing that stands out is the importance of having a long-term perspective. Almost every investor we've talked about has emphasized the need to think in terms of years, not months or weeks. They understand that the market, it's a marathon, not a sprint.
And that ties into the idea of patience, doesn't it? So many of these investors, they were willing to wait for the right opportunities, even if it meant underperforming. In the short term, they were playing the long game, trusting that their approach would eventually pay off.
Exactly. They weren't swayed by the whims of the market or the fear and greed. That often drives short-term decision-making. They had the conviction to stick to their principles, even when it was difficult.
And they were all incredibly disciplined, weren't they? Whether it was Munger's too hard box, or Templeton's commitment to buying at the point of maximum pessimism, or Gainer's methodical four-question test, they all had systems and processes in place to guide their actions.
They understood that emotions can be your worst enemy in investing. Having a disciplined approach, it helps you stay rational and objective even when the market is going crazy.
And they were all lifelong learners, constantly seeking to expand their knowledge and understanding of the world. Buffett and Munger, famous for their voracious reading habits. Templeton, student of history and philosophy. Marx is known for his insightful memos on market psychology and risk management.
They recognize that the world is constantly changing, and to be successful, you need to adapt and evolve. They were always looking for new insights, new perspectives, new ways of thinking about the markets.
And let's not forget the importance of integrity and ethics. So many of these investors had a strong moral compass and believed in doing the right thing, even when it wasn't easy or profitable.
It's about building a life of purpose and meaning, not just accumulating wealth. They understood that true success, it's about more than just money. It's about living a life that you can be proud of.
So what does this all mean for our listener? What are the key takeaways from our deep dive into the minds of these investing masters?
I think the biggest takeaway is that there's no single formula for success in investing. It's about finding an approach that aligns with who you are, your values, your risk tolerance, and your long-term goals.
It's about being a student of the markets
Mhm.
and of yourself. It's about cultivating patience, discipline, and a long-term perspective. It's about learning from the best, but ultimately forging your own path.
And most importantly, it's about remembering that investing is not just about making money. It's about building a life of purpose, meaning, and financial security.
So as you continue on your investment journey, ask yourself, which of these investors resonated with you the most? Whose philosophy aligns with your own values
Yeah.
and goals? What are the key principles that you can start applying to your own life
Yeah.
and investing approach? And never stop learning, exploring, and challenging yourself. Who knows? Maybe your own deep dive is just beginning.